Well, let me begin by thanking the organizers for inviting me to participate jointly with Managing Director Lagarde, my colleague and friend, in this important dialogue on the role of finance in society. The financial sector is vital to the economy. A well-functioning financial sector promotes job creation, innovation, and inclusive economic growth. But when the incentives facing financial firms are distorted, these firms may act in ways that can harm society. Appropriate regulation coupled with vigilant supervision is essential to address these issues. Unfortunately, in the years preceding the financial crisis, all too many firms took on risks they could neither measure nor manage. Leverage, interconnectedness, and maturity and liquidity transformation escalated to dangerous levels across the financial system. And the result was the most severe financial crisis and economic downturn since the Great Depression. Almost 9 million Americans lost their jobs, roughly twice as many lost their homes, and all too many households ended up underwater on their mortgages and overburdened with debt. To be sure, some individuals and families borrowed unwisely, but too often financial institutions encouraged the behavior that resulted in such excessive debt. In my remarks today, I will discuss some important reasons why the incentives facing financial institutions were distorted and the steps that regulators are taking to realign those incentives. Before discussing the incentives that contributed to the buildup of risk at financial institutions, I'd like to highlight the important contributions that the financial sector makes to the economy and society. First and foremost, financial institutions channel society's scarce savings to productive investments, thereby promoting business formation and job creation. Access to capital is important for all firms, but it's particularly vital for startups and young firms, which often lack a sufficient stream of earnings to increase employment and internally finance capital spending. In fact, research shows that more highly developed financial systems disproportionately benefit entrepreneurship. The financial sector also helps households save for retirement, purchase homes and cars, and weather unexpected developments. Many financial innovations, such as the increased availability of low-cost mutual funds, have improved opportunities for households to participate in asset markets and diversify their holdings. Expanded credit access has helped households maintain living standards when suffering job loss, illness, or other unexpected contingencies. And technological innovations have increased the ease and convenience with which individuals make and receive payments. The contribution of the financial sector to household risk management and business investment, as well as a significant contribution of financial sector development to economic growth, has been documented in many studies. Such research shows that across countries and over time, financial development, up to a point, has disproportionately benefited the poor and served to alleviate economic inequality. Despite these benefits, as we have seen, actions by financial institutions have the potential to inflict harm on society. Instead of promoting financial security through prudent mortgage underwriting, the financial sector prior to the crisis facilitated a bubble in the housing market and too often encouraged households to take on mortgages they neither understood nor could afford. Recent research has raised important questions about the benefits and costs of the rapid growth of the financial services industry in the United States over the past 40 years. A combination of responses to distorted incentives by players throughout the financial system created an environment conducive to a crisis. Excessive leverage placed institutions at great risk of insolvency in the event that severe, albeit low probability problems materialized. Over-reliance on fragile short-term funding by many institutions left the system vulnerable to runs. And excessive risk-taking increased the probability that severe problems would in fact materialize. Moreover, regulators and the structure of the regulatory system itself did not keep up with changes in the financial sector and were insufficiently attuned to systemic risks. Once concerns began to develop about escalating losses at large firms, insufficient liquidity and capital interacted in an adverse feedback loop. Funding pressures contributed to fire sales of financial assets and losses, reducing capital levels and heightening liquidity pressures, culminating in the near collapse of the financial system in late 2008. Several factors encouraged excessive leverage, including market perceptions that some institutions were too big to fail. Financial institutions also had an incentive to engage in regulatory arbitrage, moving assets to undercapitalized off-balance sheet vehicles. The complexity of the largest banking organizations also may have impeded market discipline. In addition, financial intermediation outside the traditional banking sector grew rapidly in the years up to 2007, leaving gaps in the regulatory umbrella. And conflicts in the incentives facing managers, shareholders, and creditors may have induced banks to increase leverage. To strengthen banks' resilience, the Federal Reserve and other banking agencies have substantially increased capital requirements. Regulatory minimums for capital relative to risk-weighted assets are significantly higher. And capital requirements now focused on the highest quality capital, such as common equity. In addition to risk-based standards, bank holding companies and depositories face a leverage ratio requirement. Also, significantly higher capital standards, both risk-weighted and leverage ratios, are being applied to the most systemically important banking organizations. Such surcharges are appropriate because of the substantial harm that the failure of a systemic institution would inflict on the financial system and the economy. Higher capital standards provide large, complex institutions with an incentive to reduce their systemic footprint. We're also employing annual stress tests to gauge large institutions' ability to weather a very severe downturn and distress of counterparties, and importantly, continue lending to households and businesses. Firms that do not meet these standards face restrictions on dividends and share buybacks. As a result of these changes, for the largest banks, Tier 1 common equity, the highest quality form of capital, has more than doubled since the financial crisis. New liquidity regulations will also improve incentives in the financial system. Prior to the crisis, institutions' incentives to rely on short-term borrowing to fund investments in riskier or less liquid instruments were distorted in two important ways. First, many investors were willing to accept a very low interest rate on short-term liabilities of financial institutions or on securitizations without demanding adequate compensation for severe but unlikely risks, such as a temporary loss of market liquidity. Perhaps these firms expected government support or simply considered illiquidity a very remote possibility. Second, institutions' attempts to shift their holdings once concerns about credit or liquidity risk arose created a fire sale dynamic that amplified declines in market values, causing unanticipated spillovers onto other institutions and across markets. Recently implemented regulations aim to strengthen liquidity. For example, a new liquidity coverage ratio requires internationally active banking organizations to hold sufficient high-quality liquid assets to meet their projected net cash outflows during a 30-day stress period. A new process, the Comprehensive Liquidity Analysis and Review, sets supervisory expectations for liquidity risk management and evaluates institutions' practices against these benchmarks. A proposal for a net stable funding ratio would require better liquidity management at horizons beyond that covered by the liquidity coverage ratio. A proposed capital surcharge for the largest firms would discourage over-reliance on short-term wholesale funding. Also, the SEC has adopted changes in regulations that may help avoid future runs on prime money market funds. And reforms in the tri-party repo market have reduced risks associated with intraday exposures. In the aftermath of the crisis, the Congress tasked the banking regulators with challenging and changing the perception that any financial institution is too big to fail by ensuring that even very large banking organizations can be resolved without harming financial stability. Steps are underway to achieve this objective. In particular, banking organizations are required to prepare living wills, plans for their rapid and orderly resolution in the event of insolvency. Regulators are considering requiring that bank holding companies have sufficient total loss absorbing capacity, including long-term debt, to enable them to be wound down without government support. In addition, the FDIC has designed a strategy that it could deploy, known as single point of entry, to resolve a systemically important institution in an orderly manner. The crisis also revealed that risk management at large, complex financial institutions was insufficient to handle the risks that some firms had taken. Compensation systems all too frequently failed to appropriately account for longer-term risks undertaken by employees, and lax controls, in some cases, contributed to unethical and illegal behavior by banking organizations and their employees. The Federal Reserve has made improving risk management and internal controls a top priority. For example, the Comprehensive Capital Analysis and Review, which includes the stress test I mentioned, also involves an evaluation to ensure that firms have a sound process in place for measuring and monitoring the risks they're taking and for matching their capital levels to those risks. Also, supervisors from the Fed and other agencies have pressed firms to improve their internal controls and to make their boards of directors more directly responsible for compensation decisions and employee conduct. As I noted, the financial crisis revealed weaknesses in our nation's system for supervising and regulating the financial industry. Prior to the crisis, regulatory agencies, including the Federal Reserve, focused on the safety and soundness of individual firms, as required by their legislative mandate at the time, rather than the stability of the financial system as a whole. Our regulatory system did not provide any supervisory watchdog with responsibility for identifying and addressing risks associated with activities and institutions that were outside the regulatory perimeter. The rapid growth of the shadow non-bank financial sector left significant gaps in regulation. In response, Dodd-Frank expanded the mandate and authority of the Federal Reserve to allow it to consider risk to financial stability in supervising financial firms under its charge. Within the Federal Reserve, we have reorganized our supervision of the most systemically important institutions to emphasize what we call a horizontal perspective, which examines institutions in a group and in comparative terms, focusing on their interaction with the broader financial system. We also created a new office within the Fed to identify emerging risks to financial stability in the broader financial system, both the bank and non-bank financial sectors. and to develop policies to mitigate systemic risk. Dodd-Frank created the Interagency Financial Stability Oversight Council, chaired by the Treasury Secretary, and the Federal Reserve is a member. It's charged with identifying systemically important financial institutions and systemically risky activities that are not subject to consolidated supervision, and designating those institutions and activities for appropriate supervision. And it's charged with encouraging greater information sharing and policy coordination across financial regulatory agencies. Well, my topic is broad and my time is short, so let me end with 3 thoughts. First, I believe that we and other supervisory agencies have made significant progress in addressing incentive problems within the financial sector, especially within the banking sector. Second, policymakers, including those of us at the Federal Reserve, remain watchful for areas in need of further action or in which the steps taken to date need to be adjusted. And third, engagement with the broader public is crucial to ensuring that any future steps to move our financial system closer to where it should be. Active debate and discussion of these issues at this conference and in other forums is important to improving our understanding of the challenges that remain. Thank you.
Congratulations. Thank you very much, Chair Yellen, dear Jeanette, and thank you very much for being here with us today. I would like to say thank you to Sheila, to Sigme, and to Annette. Thank you very much for organizing this, convincing us that this was a worthy project, and for setting the bar pretty high. Jeanette, you took us through a vivid walk down memory lane by explaining again what the financial crisis had been and how it was addressed, partly. I'd like to go just a little step further back, not to the Roman days like Sheila did. Voltaire, back in the 18th century. Voltaire was a keen observer of the reality of society. And he's known to have said about bankers, if you see a banker jump out of the window, follow him, because there is certainly money to be made. Well, the window could be the subprime or something else. I'll come back to Voltaire in a second. I fully agree with you that important progress on the regulatory reform agenda has improved the resilience of financial systems. And I also welcome the continued vigilance of the Fed and other institutions. Yet, as we all know, in too many places, financial stability is still not well entrenched. Our recent Global Financial Stability Report, issued under the leadership of José Viñals, the head of our MCM department, finds that financial stability risks are rising, rotating from banks to non-banks, from sovereign to non-sovereign, from bank solvency to market liquidity, and from advanced countries to emerging countries. Back to Voltaire, I wonder whether he would have said, make sure you follow the banker. He might have said, having read the Financial Times this morning, follow the financier. Migration from the banking sector to the financial non-banking sector. So there is still work to be done to address distorted incentives in the financial system. And indeed, action that precipitated the crisis were mostly, not so much fraudulent as driven by short-term profit motivation. This suggests that we need to build a financial system that is both more ethical and more oriented to the needs of the real economy. A financial system that serves society and not the other way around, that serves itself. So today what I would like to do is focus on how to induce a change in the culture of the financial sector, how to better align financial incentives with societal objectives. And in doing so, I think we need to look at both the regulatory environment, but also the individual accountability. So let me start with the role of rules and regulations. Today, more than 6 years on, regulatory frameworks still face several challenges that precipitated the crisis. What have we done? A lot, as Jeanette has just explained, but the job is not completed. And it may well be that because of that rotation or migration phenomenon that we observe, it will continue to be work in progress. But think of the rules that are not tight enough and oversight not strong enough, which is why we need further progress on the too big to fail institutions, for instance. Think of the culture of compensation based on short-term gains rather than sustainable profits, which induces greater risk-taking and short-termism. I remember back in 2010 when the FSB, with the good leadership in that task force of Philip Hildebrand, tried to identify what the compensation system should be to avoid that short-termism. Boy, that was a heated debate, and I'm not sure that we actually concluded in a very effective way. So how can we address these problems? We have done at the IMF in-depth work in the October 2014 GFSR, for those not in the know, it's the Global Financial Sector Report, on how compensation and governance structures can help reduce risk-taking behavior and realign incentives in the financial system. Let me highlight just two key takeaways. First, on compensation. Incentives related to compensation practices need to change so that rewards are no longer so much tied to myopic actions and excessive risk-taking. Our work showed that compensation packages can be structured to favor the long-term performance and soundness of the firm, of those who work for them. For example, remuneration should become, and in some cases it has become, should become subject to possible cancellation and clawback provisions in cases of either misconduct, performance downturn, and certainly in cases where the institution will require the direct support of taxpayers. Another way is to give the shareholders, the bondholders, a stronger voice in compensation structures of top executives. And there have been clearly positive steps in that regard. Our analysis, covering a sample of more than 800 banks from 72 different countries, suggests that shareholders' say on pay is becoming much more widespread. For example, in 2005, only 10% of the banks allowed shareholders to cast a non-binding vote on management compensation. Today, 80% of banks have instituted this policy. We have also seen some encouraging steps more recently by the SEC. The proposed changes should make it easier for shareholders to determine whether executive compensation is aligned with the firm's financial performance or not. As a reformed lawyer, I have to say that those principles have to be constantly revisited because the tendency of experts, like me back many years ago, is to work on the rules and make sure that there is a nice way around. So again, it is and will continue to be work in progress, and that should be the case. Second, changes in governance structures also matter. A key failure during the crisis was in the internal control and risk management systems of institutions. Think of the recent example of the London whale, for instance. In many cases, financial risks were either ignored or underestimated, and in the particular case of systemic risks, they were not well understood at all. Failure happened at both the management and the board level. So one way to address this failure is certainly to establish a clearer distinction between the management on the one hand and the board on the other hand. We have seen that banks with more independent board members take fewer risks. Another way is to ensure qualification and skills of board members and key technical professionals through rigorous fit and proper criteria. And to make sure that, again, that is also work in progress. I sat on the board of ING back many years ago, and the business of the bank was changing so quickly that constant training programs were actually necessary for us to understand what was going on. It was the beginning of e-banking in those days. That's where actually Rousseau could come back to the rescue of Voltaire, which is a bit unusual. Training, and education. But regulation alone cannot solve the problem. Whether something is right or wrong cannot be simply reduced to whether or not it is permissible under the law. What is needed is a culture that induces bankers to do the right thing even when nobody is watching. Ultimately, we need more individual accountability. Good corporate governance is forged by the ethics of its individuals, and that involves moving beyond corporate rule-based behavior to value-based behavior. We need a greater focus on promoting individual integrity. In the Aristotelian tradition, virtues are molded from habit, developing and nurturing good behavior over time. Again, Rousseau help us. Education, training. One clear solution is to set a strong tone at the top of the institution. As the Chinese say, the fish rots from the head. Establishing a culture where ethical behavior is rewarded and where lapses in ethical integrity are not tolerated but are sanctioned. You will forgive me, Igme, but I believe very strongly that more women leaders would also help. There have been many studies now. Many studies have shown that female leadership is more inclusive, probably a little bit more risk adverse, but there might not be something that wrong in being occasionally risk adverse. I don't mean to be excluding anybody, by the way. But you might remember a question that I too asked. What would have happened if it hadn't been Lehman Brothers, but Lehman Sisters? Now, against this background, I hope to see more work done on governance, on change in risk culture. The fund has always been a strong supporter of regulators and supervisors, independent supervisors as well, and we will continue to do so. But I would like to see institutions themselves take up this matter. Shareholders, bondholders too. There should be a drive in the private sector for better alignment of risks and incentives. And this applies both to advanced and emerging economies. And indeed, emerging economies can learn a lot from the valuable lessons from the pitfalls of their advanced counterparts. On this point, we released a study a few days ago that re-examines financial deepening from the viewpoint of emerging markets. A key finding is that the gains from growth and stability from financial deepening remain large for most emerging markets, but there are limits on size and speed. When financial sector development outpaces the strength of the supervisory framework, there is excessive risk-taking and instability. The experience in many countries, including in the United States, has exposed the dangers of financial systems that have grown too big, too fast. Our analysis on emerging markets shows that regulatory reforms can actually increase the benefits from financial development while reducing the risks. I'm sure many of you have heard, and some may have said, excessive regulatory is going to refrain from good financial innovation. As a finance minister, I've heard that many times a few years ago. But based on that studies, that fears that change to the regulatory frameworks would curtail credit, hamper financial development and innovation, and stifle growth may very well be misplaced. On the whole, the same set of principles that increases financial depth also contributes to greater stability. Better regulation leads to greater possibilities for development and stability. Here, let me step back and highlight the important distinction between financial depth and financial inclusion, especially as we strive this year to deliver on important milestone, 2015, the year of development, the year of financing for development, the year of sustainable development growth. Financial systems around the world are quite sizable, but they exclude many individuals. Many individuals, many firms from financial services. I resist the temptation of asking you to guess how many people are actually excluded. 2 billion. 2 billion people worldwide remain without a bank account. 2 billion people do not have a bank account. Now, there has been improvement because it's 20% less over the last 3 years. But still, 2 billion is a massive number. Moreover, financial exclusion is far from being solely a low-income country or an emerging market issues. For example, even here in the United States, surveys find that some 8% of US households are unbanked and some 20% are underbanked. Studies show that broader access to the financial system can boost job creation, increase investment in education, and help people manage risk and absorb financial shocks better. Our own analysis that will be released later in the autumn finds that financial inclusion is particularly important, for women, empowering them economically and allowing them to invest in education, which they do a lot more than their male counterparts. So there is scope for improvement. Market penetration. Globally, still on women, a staggering 42% of women lack access to basic financial services, compared to 35% for men. This gap is even bigger if we consider the role of women in the provision of financial services. Yet desirable as it is, as an objective, financial inclusion is not without risks, particularly if it leads to excessive financial risk-taking. Our forthcoming analysis shows that if supported by good regulation, good supervision, and independent supervision, financial inclusion can actually go hand in hand with financial stability. So in conclusion, the financial crisis has exposed several fault lines and provided many lessons. An overarching lesson is that building sustainable and inclusive growth hinges on collaborative efforts. It requires supervisors and regulators to work on managing risks and to work together. It requires building resilience in all countries. It requires realignment between corporate culture and societal objectives. One final point. I hear, and I have heard many times over, that it would be so much better if bankers were boring again. You know what? I fundamentally disagree with that, because it takes the view that for bankers to finance the real economy is boring. It is not my definition of boredom, and I don't think it should be ours. Financing companies, providing credit, assessing risk properly, transforming maturity between savings and investment and over time is not a boring activity, and it should be regarded as a high-value activity. And if the definition of boredom is working for the real economy, and the definition of excitement is just making a lot of money, I think we have to change a few things around here. Thank you very much.
So, Christine, I wondered if you would tell us a little bit more about what the fund is doing all around the world to improve regulation and supervision. I know you have active programs, and it would be good to hear a bit about what your involvement is.
We operate at different levels. We operate at the global level, and we see each other regularly, and Jose is the representative of the fund at those meetings. We participate in the Financial Stability Board. We sit on various committees that often meet in Switzerland, and we try to bring a perspective that is not so much the central banker's perspective, or not so much the supervisors of a particular country's perspective, but a more global perspective. And we are also trying to bring to those meetings the views and the voices of those that are not necessarily represented. And I'm here thinking about some of the emerging market economies, some of the low-income countries, and that, I think, is a critical role that we have to continue playing. Then at the local level, there is a lot of activity going on, either when we do the annual sort of audit of the economy of our 188 members, because very often experts in banking, monetary policies and finance join the teams, and that is taking place annually when we do what we call the Article 4 review. But we also do something that is highly valued by the membership, which is called the FSAP. It's the financial sector assessment work that is done by a specialized team, and they will come for quite a while to actually go under the skin of the banking and financial sector and give a candid sort of third-party assessment of where the risks are, what the policies should be, and it's a really good health check that is valued by the membership, and very often published as well. So it gives transparency to the review that we do. So that's pretty much it in those two. Yeah, no, I try to dissociate what we do sort of globally and what we do at the national levels as well. Is it for me to ask you a question?
Would you like to would you like to take a turn?
Yeah. I thought you were going to ask me two, and I would ask you one.
Okay, I thought we
could
that's alternate,
fine.
but
that's
as you.
No, that's fine. I just want, I know what the one I wanted to ask you, and that's the one that, I have sort of, I don't do Financial Times advertising, but frankly, I thought that front page was quite staggering. Now that that the banking sector, in a way, has been much better recapitalized. You mentioned the quality of the capital required, the overcharge on some of the large players, the liquidity ratios, a degree of leverage limitation, which there's a lot to be said about that. So it seems that there are quite a lot of tools that have applied, but as we're seeing, there's a development of a shadow banking. No, not shadow banking. They don't like shadow banking because it feels a bit weird, doesn't it? So they prefer the financial non-banking sector, which is probably more inclusive, where you have some really helpful and needed people, but also some who take massive risks. Shouldn't regulations go beyond the banking sector, and shouldn't there be more supervision, particularly if some of those players were to call on the taxpayers' support at some stage?
Well, that's a great question, and I think absolutely the financial crisis just very clearly revealed that even outside the regulated banking sector, in the shadow banking sector or non-banking part of the financial sector, we had risks that were very similar to the risks we've traditionally had in banking. An example is that Lehman and Bear Stearns, the two firms in AIG that got into the greatest trouble during the crisis, were not regulated banking organizations at all, and yet the risks that they were taking were very similar to the kinds of risks that have led to runs on banks in the past. And markets, the repo market, the market that developed for asset-backed commercial paper, money market funds, all of these markets developed, they're important sources of credit for the economy, but they also had run-like characteristics. So when troubles developed, there were essentially runs in these markets. And in some cases, as you mentioned, the government and the money market fund case did come in and step in. So it is very important that we keep an eye on and appropriately regulate the shadow banking sector. I think we're making some progress. The Financial Stability Oversight Council is charged with designating some non-bank institutions as systemic and then putting them under Federal Reserve supervision. And so far, they've designated 4 non-financial companies and then also 8 of what they call financial market utilities, entities that are either do central clearing or play a key role in the payments and settlement system. These have been designated and are supervised and recognized to have systemic risk. We have adopted new regulations. We saw problems in securitization. The fact that in the run-up to the crisis, so many securitizers didn't really keep risk on their own balance sheet. They didn't have skin in the game. And we've put in place new regulations that ought to make a significant difference. Money market funds, the SEC has put in place new rules for prime institutional funds that get rid of the fixed dollar value. They'll have floating NAVs or net asset values that I think will reduce run risk there, although the SEC did decide to allow firms to impose gates and fees, and that's something that could create financial stability risk we need to watch. The so-called tri-party repo market, which is a major source of short-term wholesale funding, that contained great risks that we've taken steps, important steps to mitigate. Central counterparties, a thrust of reform has been to try to move as many derivative contracts as possible into central counterparties, to have them cleared by central counterparties. And that's something that serves to reduce risk and complexity and enhance financial stability, but then these entities themselves become systemic and clearly need supervision. Something that you have mentioned in IMF work is that we have a major growth of open-ended mutual funds, where you have funds that are investing in highly illiquid assets, and yet the investors in those funds are promised immediate liquidity. And if there are runs on those funds, you have a kind of liquidity maturity transformation there, can give rise to very substantial moves in asset prices. And you've highlighted that, and we're focused on that as well.
The liquidity illusion.
Yes,
Yeah.
yes. So let me come back to you,
Yeah.
Christina, if I could, with a question. The regulatory reforms that are taking place in the United States and Britain and elsewhere, there may be spillovers to emerging markets. And I wonder if the fund is doing some work in trying to assess what the impact of these reforms might be on other countries.
Sure. Yes, we do, and we do that thanks to the both the global role that we play and the national level involvement that we have. I think at the global level, what has been really striking for me is how we have been able to bring together regulators and supervisors who sometimes did not have a chance or did not pay attention to what could have been or what were loopholes, space for arbitrage, and there have been quite a few of those forums. So we play that role of bringing together all those that are changing their rules. And I remember vividly a meeting we had with Vickers, Liikanen, and Volcker, all present in the room, together with other central bankers and supervisors, and actually discussing where one set of rules was going to actually be an issue for another region where different regulations would apply. So I think we play that particular role. In terms of spillover, what we have certainly observed lately is, because of the different business model that is induced by the new regulation, as a whole, we have observed a change in the banks themselves, where their size has reduced, where their footprint has changed as well, and where a lot of those subsidiaries or branches that were in the entire world. You know, remember those days when banks were saying, we are global, and they would have that map of the world with lots of points on the map to say, we are all there? I think the map would look a lot different today. And that has caused them to sell their operation to generally regional banks, to national banks out there that are prepared to grow and that were prepared to, you know, take over what the large players were downloading essentially in order to satisfy the requirements. So there has been that particular spillover aspect. The third role that we try to play is to actually help emerging market economies, low-income countries and developing countries actually adjust to the change of regulations and import in their own regulatory system the proper set of rules that will help them deepen their financial market and make it more inclusive as well as safer. I think the study that I just referred to, which shows that deepening and including and more inclusive financial sectors are actually not, it's not mutually exclusive from stability and growth, provided that there is the right set of rules and supervision in place. So we work very hard on those principles. Okay, back to me to ask you a question. And in a way, I'm going back to my point about the alignment of incentives, and with the the societal purposes and the good finance, as Sheila described it earlier. And you talked yourself about the danger of distorted incentives in the financial sector. There are critics out there who will argue that with very, very low interest rates, zero interest on occasions, this is actually distorting incentives and leading to build-up of risks to financial stability. So what can you tell them?
So I think this is a very important question. And I think what I first have to say is that interest rates, low interest rates in the United States, we've had the federal funds rate, our target has been at zero for an unthinkable 6+ years, and we're now seeing interest rates at zero or even negative levels in other advanced countries. There is a reason for this. The reason is that we really think this policy is necessary to help our economies move back to full employment and to achieve our price stability objectives. And in terms of financial stability, meeting those objectives actually has a favorable financial stability effect. Low interest rates have supported job creation and economic growth. It's helped households, certainly in the United States, engage in balance sheet repair to be able to pay down debt, and they are in a much sounder position as are banks. But it is true that in a low interest environment, we need to be sensitive and watch for risks to financial stability. Low interest rates can certainly incent some investors to reach for yield. It can incent them to take on leveraged positions that, if they unwind, can create financial stability risks. And I guess we're doing two things. We're monitoring very carefully to look to see if those risks are developing. And to the extent we do see some risks developing, of course, we're trying to take action where we can, but we're speaking out more generally about the risks that we see developing. And I give you a couple of examples. In the market for leveraged loans, we're certainly seeing reach for yield, and we're seeing a deterioration in underwriting standards. And that's something we've been highlighting for a number of years. And in our role as a supervisor of financial institutions that are underwriting these loans, we are trying to ensure that underwriting standards move up and are higher. to diminish risks. We've also seen a compression in spreads on high-yield debt, which certainly looks like a reach for yield type of behavior. I guess I would highlight that equity market valuations at this point generally are quite high. Now, they're not so high when you compare the returns on equities to the returns on safe assets like bonds, which are also very low, but there are potential dangers there. And in interest rates, obviously, not only short, but long-term interest rates are at very low levels, and that would appear to embody low term premiums, which can move and can move very rapidly. We saw this in the case of the taper tantrum in 2013, where there was a very sharp upward movement in rates, and you do have divergent monetary policies potentially around the world. We need to be attentive and are to the possibility that when the Fed decides it's time to begin raising rates, these term premiums could move up and we could see a sharp jump in long-term rates. So we're trying to, as I've repeatedly said, communicate as clearly about our monetary policy so we don't take markets by surprise. In addition to that, I'd say low interest rates can create interest rate risk at financial institutions. Many banks are finding their net interest margins compressed. They have an incentive to take on additional duration or credit risk. And if interest rates move up, that can create risks. In our supervision and in the stress tests, we're looking for that and analyzing their ability to withstand that. Insurance companies, pension funds are subject to the same kind of pressures in a low interest rate environment. They find it hard to meet their return targets. And so FSOC staff and other regulatory agencies are monitoring, for example, in insurance companies and pension funds. But so overall, though, I think my assessment at this point would be that risks to financial stability are moderated, not elevated at this point. And I say that because we're not seeing any broad-based pickup in leverage. We're not seeing rapid credit growth. We're not seeing an increase in maturity transformation. And I would call those things kind of the hallmark of a financial bubble or the precursors of a financial crisis. But these are things we're, of course, focusing on very carefully.
And if I may follow up, I know we're just about to run out of time, but compare with the situation in 2007, and I remember those days when your predecessor and Hung Paulson was telling us, the Europeans, well, there is search for yield. Yes, there is bubble formation, but it's pretty much under control. To the point where they found out that they did not have the legal grounds, they did not have the legal basis or the macroprudential tools to actually address them in due course. Are you better equipped today?
Well, I think we are better equipped today. Simply because there are very few, in some of these markets, money market funds and repo markets and so forth, we have improved regulations, so those things, I think, function better than they did before the crisis. And we don't really, I think we weren't aware in the run-up of the crisis of what was happening in broker-dealers and investment banks. And there were many that were standalone entities that were not banking organizations. Now we have, as I mentioned, much higher capital and liquidity standards, and that applies to all of the major broker-dealers and investment banks. So I think there was a great deal that we missed before the crisis, and I believe we're better positioned now and have better tools.
Okay, I think we have, I see them all saying time off. So we will say time off, and thank you very much for your patience and for listening to both of us. Thank you so much.
Thank you. Pleasure. Thank you.